Hey, I just finished reading a fascinating article about nature's way of separating the predators from the prey. No, it's not the claws or sharp fangs which define a predator. Apparently, the truth lies in the eyes of the creature, at least up to a certain height. Confused? Ah, please don't be. I, if I get this correct, like the boffins who discovered it, um, check this out. You're gonna love it. See, the eyes with a vertical slit pupil shape and facing forward in the skull mean that the creature is a predator, and the eyes with a horizontal slit pupil shape positioned on the side of the skull say, "Eat me." Basically, the creature is prey. But this rule breaks down slightly when the prey are above 16.5 inches at shoulder height, when the pupils become more rounded, like with us. And this is why tigers and lions have round pupils. But this is most interesting to me because it means the prey and the predator literally see a different world to one another from different shaped eyes. And it made me think about a business when it is ready for a sale. What eyes are it attracting, and does it look like prey to a predator-like seller? For example, it is possible a business owner would want to sell their business through a third party like an investment bank. This means the business owners is inviting a team who focuses their business development on helping business owners exit their companies. I mean, let's take an example of a very large one like Morgan Stanley Investment Bank, which is really one of the world's largest investment banks. And Morgan Stanley's target market for a company is generally in the 500 million enterprise value and up. And because of this high minimum, Morgan's developed a platform of middle market investment banks for sales below that 500 million range. So they currently have about 14 middle market investment banks working domestically and internationally on their platform. And this team works a lot with these banks to help the owners sell their businesses. So investment banks, they charge a percentage of the sales price of the business for their fees, and that can sometimes lead to some independent business owners to consider doing what the investment banks do for themselves. And this is okay in theory, but it's probably not recommended. There are many reasons I don't think that a typical business owner should do this on their own. If you think about it, the owner is one of the most emotionally attached to the business, and he or she would likely find it difficult, if not impossible, to negotiate with a prospective buyer in a detached, dispassionate and effective manner, like you'd expect a banker to do. Now, in the middle market space, those business sizes, most of the buyers are experienced and they're skilled in buying up companies. The sophisticated buyers have a much greater advantage over the owner selling their first-time business. I've seen a number of these deals go sideways late in the process because the sophisticated buyer, knows the weaknesses of the seller, and then they try to negotiate the price down, something that is called a retrade due to a number of items or faults that they found in the due diligence process. Further, at some point, all sales negotiations become intense. An experienced investment banker, they can anticipate this, and they can manage the inevitable lows and storms that few buyers have the stomach to endure. But let's say that an owner will have no problem navigating rough waters of a typical sales process. Well, the question really is, can they do this while simultaneously doing everything necessary to keep the business running at full speed? Really, it's rare that an owner can keep the company running at peak performance while negotiating the sort of things that occur in a sale, if you will. And any drop in company productivity or sales or income, that's just like blood in the water for a sophisticated buyer, and they'll be subject to buyer scrutiny, and this has the potential to scuttle even the best of deals. So why should an owner use an investment banker? There are a few reasons, and there are other reasons for not going it alone. So I think the answer is yes, sometimes, and yes. And there's also the fact that the owner is better positioned to remain detached from the sales process, but yet remain in control of the process. You could get a situation if the investment banker reaches an impasse with the buyer's representative. The owners can assert their authority, if you like, and insert themselves at the appropriate time to break the deadlock in the deal. This is really a precious capital that the owner can afford to squander by being in the thick of the fray. You know, they can't be in there day in and day out in the negotiations. So probably I would say one of the most important reasons to use an investment banker is because of the auction process that they can run. See, an auction very simply is where the investment banker lines up two or more interested buyers and then pits them, if you will, against each other to drive up the final price, possibly closing deals at a price considerably higher than the owner believed was possible. So needless to say, the owner would be very happy to have used the investment banker at the conclusion of the deal. And a good investment banker can really be valuable for assessing the marketability of the company, accurately pricing and valuing the company, locating buyers. This is very important. It has a lot to do with the investment banker's network, so working with an investment bank that has national and international versus just a local relationship is very important. They're also good at conducting competitive options, as I just mentioned, like negotiating and closing the deal. So for all these reasons, I see most owners very satisfied with the sales process using an investment bank. So what kind of company is a good client for an investment bank? Well, first I'd say that a lot of this is subjective, based on, you'd have to ask that specific investment banker that you've been referred to. But let me give you a sort of, some general guidelines. Well, first of all, size does matter in this space. In general, having a minimum EBITDA, that's earnings before interest, taxes, depreciation and amortization of between 1 or 2 million is important. Ideally, being in an attractive market sector is helpful. Buyers are always interested in how strong the fundamentals of the companies that they are looking at are. For example, is the company growing its sales and income and market share? How strong are the margins, etc.? See, the owner should be prepared to discuss the company's competitive advantages and also have how concentrated the customer base is. This is one of the areas that could limit the amount of upfront cash, because of that there is a risk to the buying company if there is too much concentration. So they're going to want to defer the payments to the seller, and that could last as much as 3 to 5 years. This is very interesting because it means this customer concentration issue is one where you would want a good investment banker doing the negotiations. So the investment bank, they may not be able to avoid the deferral of some of the payments, but they'll have experience in this type of sale. They know what's reasonable. And of course, they'll negotiate to reduce the deferral as much as possible and get any sort of guarantees for the sellers as possible. So this is one of the ways you can prepare for your business for sale and not look like a buyer's lunch. So happy grazing.